Welcome to the post-lunch lively panel interview. I'll try to keep it interesting for you here. I'm Greg Head, and I'm honored to be with some esteemed venture capital investors and another kind of investor. We're going to get into all of that here. Tehi, why don't we start with you? Why don't you give us a brief introduction about your firm and what stage you're investing in for this audience to know what stage of the life cycle you invest in.
I'm a managing director of Storm Ventures. We're invest in early stage B2B software companies all across the world except China. And we just closed our 7th fund for $230 million.
And what is early stage for this early stage audience
So
here?
we would do seed and Series A.
Great, thank you. Kathy, why don't you introduce yourself?
Thanks, Greg. First of all, it's so great to be here. I'm Kathy Gao. I'm a partner at Sapphire Ventures. We are proud to say that we are a local firm. We have an office right here in Austin, Texas. Sapphire is focused on B2B enterprise companies, and we follow right after Tehi. So we're focused at the Series B all the way to pre-IPO.
Great, thank you. Miguel?
Yeah, hi everybody. I'm Miguel. At CapChase, we are a fintech for SaaS companies, and we have two types of products. One is a revenue-based financing product. So think of for companies between seed to Series A, all of them B2B SaaS. They can turn part of the ARR into financing, usually as a complement to VC or to their own funds, to the bootstrap. And the second product is a software buy now, pay later, so that SaaS companies can sell to more customers that commits to a full annual contract. They get the payment from CapChase upfront on day zero, and they can provide flexibility to the customers to pay for that annual license over time. So monthly, quarterly, or however they want.
So Miguel, let's keep going with that. So we're talking to venture capital investors that invest for a piece of the company, the equity, but you're not an equity investor. You're doing revenue-based financing and now the buy now, pay later financing for B2B SaaS companies. Everybody up here is for B2B SaaS companies. 4 or 5 years ago, revenue-based financing wouldn't have been on stage with venture capital. You've got quite a large firm. Why don't you describe just the scale of what you're up to right now and how many companies you're working with?
Yeah, perfect. So it's true that revenue-based financing is a pretty new niche, at least for the SaaS ecosystem. We started about 3 years ago. We have raised equity ourselves because it is a capital-intensive business, so we needed to fund it with equity capital. And now we've worked with thousands of companies across the US, Canada, and Europe, so most of the European Union and the UK. And we've made available, I think it's about $2 billion to date. And this year, we'll surpass that barrier and grow faster than ever.
So you're not a small firm. You've raised how much equity?
Yeah. We've raised about $110 million in equity and about $900 million in debt. I think we're going to talk about when to use equity versus when to use debt or revenue-based financing. So we do our own favor of that. We use equity for our operations and for our technology, and we use the debt that we've raised to just provide financing to our customers or to their customers to buy the products.
Okay, my last question for you, and then we'll come back to the equity discussion here. Are most of the CapChase customers that are doing revenue-based financing, which I would say is a form of debt, it's not really an interest rate like a venture debt or something like that, are the majority of them bootstrappers that are using this kind of financing to procrastinate an equity round or to avoid an equity round? They're bootstrappers trying to grow a little bit faster? Or is it used mostly in conjunction with a venture capital investment round to create leverage on top of the equity?
Yeah, so actually both.
Okay.
So it's about 50% of our customers are bootstrapped, 50% are VC backed.
Yeah.
But they all use it for the same thing, right? And if you think about it, almost like the way that we use it, right? So if you're a founder, you usually you can bucket your activities into two big areas. One is long-term activities, so things that have a long-term return, uncertain, and things that are shorter term, So they have much shorter payback, and it's almost like a formula that works. So for example, long-term return would be investing in new products, in entering new markets, in R&D. So things that like you don't know if they're going to work. If they work, it's amazing. It's an asymmetric outcome. If they don't work, well, you better not have to return the money that you spent, right? So that's what equity is used for. You know, equity is a long-term form of capital that you usually don't have to return in the form of cash flow. You return it when you sell a company, right?
Right.
So this is why the VC industry exists, but you don't return it in terms of cash flow. Short-term activities that follow a formula would be anything around customer acquisition, working capital. So after a while in a B2B SaaS company, you know that if you spend a certain amount in customer acquisition, in CAC, if you understand how much money you're going to get from those customers and from those cohorts, you have your payback period, right? So that becomes a formula that is repeated all over again. So then what we see is that both bootstrapped customers and VC-backed customers use CapChase funds for that part of the business to fund activities that they know they're going to return more than the cost of capital in a short term, and therefore their equity goes much longer because they use the equity only for the long-term stuff.
Okay, so that's more short-term, very high confidence because they have to pay you back, unlike equity.
Exactly.
There. So Tehi, we've lived through the growth of SaaS and the funding environment. You've been investing in B2B software companies for a long time. And 2020, 2021, it was leading up to that, but there was a huge surge in investing and valuations, and I don't know if we call it a bubble, but at least there was a boom time. And now we're not in a boom time. I don't know if it's a bust, but so forth. How has your firm been investing in early stage companies, before COVID, post-COVID, before the boom?
So we've been investing since 2000, and as a result have gone through like a 2000 meltdown, 2007 meltdown. And what we've learned is, which is very hard to do, is to control your emotion. And so in good times, you want to invest more. And in bad times, you just don't want to show up at work. And so not make any investments. And the best thing is just to be consistent, whether through good or bad. So we try to maintain that consistent deal flow.
So how many deals is your firm investing in a year?
We try to do around 10 to 12 per year.
10 to 12 deals. So how many companies do you need to talk to do 12 deals? So there's a crowd out here, and maybe they could apply the math. If you talk to everybody, it wouldn't be 50% of the ones you invested in, it'd be 1% or something like that. But,
well, I mean, that's the thing is that in venture, you don't really get rewarded for effort. You just get rewarded for results. So, we're wanting to invest 10 to 12 companies per year, and if you can just meet the right 10 to 12 and you invest, that's great.
And that happens very often, apparently.
I wish it did. It would make. I mean, I have friends who are unbelievable venture capitalists, and they meet very few companies.
Yeah. So you're investing in 10 to 12 companies a year out of your firm. What is a typical B2B SaaS ARR revenue, and what's a typical investment? Are they heading towards 5 million ARR, and you're investing 10 million, or what's a rough range for the types of investments?
Yeah. So our Series A investments are primarily around $500,000 to 2 million ARR.
Okay.
But one advice I would give to founders is what really, from an investor standpoint, when you just meet an investor and the investor meets you for the first time, it's like we just get a snapshot of each other.
Yes.
What's better than one snapshot or intensive meeting is to have at least 2 data points so you can draw a line. So rather than meeting a company with 1 million ARR, if you met a company early on at 250 and then you met them 3 or 6 months later and they're at 750, you have more confidence in the trajectory than one meeting with a very good ARR number.
The trajectory of revenue and the...
It's always easier to draw a line with 2 data points than one,
And you can handicap a founder's ability to do what they say they're going to do.
Right. That's what we see with experienced repeat entrepreneurs, is that they like to give previews. It doesn't mean a full pitch, but enough that you get a feel of what they want to do so you can track the company.
Yeah. Kathy, what's a typical size of company and size of deal that you would be investing in, Series B and above, these days?
Yeah, so our purview is pretty broad, I would say. As I mentioned before, it's really Series B all the way to pre-IPO. I want to answer your question in two ways,
Yeah.
right? Because there are things we look for from a financial metrics perspective, but there's also things we look at from an operating perspective, operating traction, operating maturity perspective. Very high level, from a financial metrics perspective, we oftentimes look at ARR. And typically, for most of our investments, we're looking at companies that have surpassed the 10 million ARR mark at the time we're looking. But Taehi touched on a very important point, right? When you meet a founder for the first time, you are literally just getting one snapshot of that individual and of that company at that point in time. What I'm really curious to know, and because by the time I'm talking to the company, there's more data points than when Taehi was talking to the company. I want to understand how that company has grown historically. What has the growth rate look like? Have they consistently delivered what they said that they would in terms of budget versus actuals? Those are all very important things. At a very high level, that 10 million ARR mark that I talked about is mostly artificial, right? There's no line in the sand saying, okay, if you're under 10 million of ARR, we're not interested in investing. It's just a hard and fast rule and a proxy to understand if a company has deep product market fit, they have a go-to-market motion that is working, and we want to come in when that go-to-market motion has been developed and give the company money so that they can continue to invest in something that's already working, hopefully, turning $1 into multiple dollars.
Right.
On the operating side, growth isn't everything. Numbers can be very deceiving, which is why you need to spend time to really understand the story behind the numbers. And I'll give you guys a very specific example. You can see one company maybe went from 0 to 5 million ARR in, let's say, a year. High level, amazing, right? 0 to 5 in 1 year. But if you dig a little bit deeper, you might realize this is a very hardcore, heavy-duty enterprise software company, and maybe they're selling into the life sciences industry where 2 million, 3, even 40 million ACVs are unheard of. And maybe that 0 to 5 was really one customer that may be in pilot phase. So in that situation, that company is not mature enough for our mandate to come in and provide growth venture capital.
Well, the later stage BCD investing has really changed in the last 2 years. So can you give us a sense for how many companies you were investing in, say, in 2021 versus 2023? The late stage investing is, I don't want to say collapsed, but it's the public markets are way down. There's more resistance growing to grow a serious business right now. But how has your investing velocity changed?
Yeah, absolutely, Greg. That's a great question. Just so people know, on average, we expect to invest anywhere from, can you guys hear me? On average, we expect to invest anywhere between 13 to 15 new companies per year.
Okay.
Now, in 2021, I'll say we invested in a lot more than that number. And in 2022, that really slowed down for a couple of reasons. But a primary two I'll give you. Number one, the public market comps that we track very closely. And what I mean by that are the valuations of public software companies that we look at in order to proxy how much private companies might be worth. Valuations fell in excess of 70%.
Yeah.
That's number one. Number two, so many companies raised in 2021. If I just look at our Sapphire portfolio, almost all of our portfolio companies did raise some sort of equity financing in 2021. So the combination of those two factors meant that the market was just very, very slow, in particular for growth stage investing.
Right.
So I think we did, far fewer than our target in 2022. Now, the big question is, what is it going to look like in 2023, this year, and beyond? And my observation of the market right now is that things are picking back up slowly but surely. This year alone, we've already closed on 2 deals, and we're signing up a third right now, and we're seeing very, very active pipeline. But these things will just take time. It's a tough macro environment out there right now, but we're seeing positive signals.
So let's talk about the macro environment. Software entrepreneurs are dealing with things right in front of them. Their customers, their products, their channels, their employees. They're kind of living from day to day. They're growing a 1 million ARR, 5 million ARR, get to 10 million. Why is growth stage funding in particular so sensitive to the multiples of what's happening in the public markets? The tech stocks were crazy valuations in 2021, and now they've come down, as you say, 70%. Why is your growth stage investing so tied to what's happening in the macro public markets?
The closer you invest to an IPO, the more you have to look at public companies because that's theoretically what your exit value will be. So if someone said to you, how much would you pay for anything, an object, if your goal was to make money by selling that object next year? Well, the rational thing to do is to go to a marketplace or figure out how much you think that object will be worth in 1 year. So that same analogy applies, right? If we're investing in a pre-IPO company, we have to look at similar companies that are already trading on the public markets. And so when I mentioned earlier that the public market comps crashed in 2022, starting really in November 2021, by 60, 70, sometimes 80% in certain cases, in our models, when we do the analysis, what before we were underwriting to X valuation, that might have dropped, maybe not 80%, but by a significant amount, which means we have to rethink how much we want to pay for that asset at entry.
Right. So thanks, Kathy. And your company, just to be clear, you're investing in even just Series B with a trajectory of being either going public or getting those kind of exit valuations in a reasonable amount of time. You're that later stage, so to speak. Miguel, what stage are most of your companies? I guess revenue-based financing could apply to a $100 million software company and a $1 million ARR. Where is the majority of your investing happening? For instance, do you invest in the pre-Series A to help them get acceleration so Tehi can build them up to 10 million so Kathy can do it? Or are you investing at every size and stage of SaaS company?
So again, it depends on the product, right? So for the first product, revenue-based financing, we typically work with companies up to Series B. So all the way from seed, A, and B. At some point, those companies become, once they go past the 15 to 20 million ARR, then suddenly they can access pools of capital that are cheaper, larger in size, and probably longer duration. So they behave almost like an additional tranche of equity. I'm talking about banking debt or venture debt provided by big venture funds, right? They will provide like a 5-year term loan, which essentially behaves like equity. For those companies up to 20 million ARR, the average amount they can access at any given time is usually a percentage of the ARR. So from 10 to 70% of the ARR in the best cases, in the companies that grow the fastest. On average, it's about $500,000 per company, but the range can go from $50K on the low end all the way to about $15 million, 1-5. On the buy now, pay later product, where it's the SaaS company essentially offering financing to their customers to commit for a full year but pay flexibly, our customers are way larger. So they're usually SaaS companies above 10 million ARR. Our largest company is a public entity with about 400 plus million ARR. And the amount of financing they can access is pretty much all of the ARR because they are not getting the financing. They are distributing the financing among their customers, both new customers and renewals, to help with conversion and with retention.
So how did the macro events of the last 2 or 3 years, I guess, the COVID tech boom, the equity VC early stage surge, then interest rates coming up, and then Silicon Valley Bank going bust in a weekend. Did you invest steadily like Tehi across the, the waves were doing this and they were steadily investing? Or how did that affect what you were doing? And you're a relatively new business, so it's not like it's been going on for 10 years. So,
good question. It's been 3 very fun years, to say the least, right?
Yeah.
Boost, sorry, yeah, like the COVID boost and then the slump after that. So think of it as we invest in the same companies. Like let's say that this is our targets. This is how we like the companies to look like.
Yeah.
So before, during COVID, when everybody was growing and money was infinite, there were a lot of companies that would fit there. And now, there are less companies that fit there, right? So I would say that we've been investing probably the same amount this year as last year. Well, maybe like 30, 40% more this year than last year. But we've had much more demand, which means that we are taking a narrower slice of that augmented demand. And how it has impacted us as a company, not much, because we chose to be very disciplined. And I think back in December 2021, we saw that companies' performance across all the companies that we're applying was starting to deteriorate. We're seeing sales cycles getting delayed. We're seeing LTVs dropping, retention dropping, growth becoming more expensive, so CAC getting higher and higher. So then we decided to reconsider our credit policy.
Right.
That meant that during 2022, we're actually able to navigate extremely well, but most of our competitors disappeared, right? So we had a lot of competitors that went out of business because they had chosen growth over discipline, whereas we chose the opposite. Then what happened with the interest rates increase is that, well, 2 things at the same time. One, every founder was suddenly, to at this point, seeing that they were not going to grow into the valuation. They had raised at the top of the multiples, at the top of the market, maybe at 30, 50 to 100x multiples, and now the multiples had compressed, let's call it 50, 60% in most cases. So then the only option they had to grow into those multiples was to either grow for longer or grow faster. So the answer to both of those is probably either and. You need to cut costs and you need to find more capital to either increase that slope that we're talking about, or just do it for longer and hopefully grow into the same valuation with a more discounted multiple. That meant that there was much more demand. People were looking left and right. If there's no equity or equity is very expensive, then who else is giving money? And we were there, as one of the main investors, along with other companies, included SVB. Then what happened in March? Well, SVB blew up, and then FRB and all the regional banks completely drew back their capital lending to growth startups with negative EBITDA. So again, more demand, but also there's much more volatility, so risk is higher than ever. So we just need to remain focused and be cautious about who we're working with.
So you're seeing more demand, and there's a little bit less supply, perhaps overall in the market, and you're being more choosy about who you invest in now. How many companies, you talk about seeing CAC raising and everything slowing down, how many companies do you have exposure to, Miguel? Are you seeing inside thousands of SaaS companies with the metrics every month, or how many companies can you see?
I think, off the top of my head, the applications per month would be in the several hundreds.
Yeah.
I would say, and then our portfolio is comprised of several hundreds as well.
Okay.
So every month we're signing up a bunch of new customers, and also some of those graduate when they reach that $15 to $20 million mark.
Right. Tehi, what have you seen in your side of the early stage venture? You're investing all over. You're based in Silicon Valley, and what have you seen in the last 2 years with the demand for early stage investing, and what you're changing metrics or you're changing measure for the kinds of companies you'll invest in?
Right. So there's been a dramatic change in the marketplace. It's just supply and demand. 2 years ago, there was so much more supply of seed and Series A money, then there was demand from startups, and now it's completely inversed, so that there is a lot more demand than there is supply. How that impacts us has less to do with metrics in terms of when we go in, but instead what we're able to do is just watch the company a bit longer. Before we would have to make fast decisions, and now because of the change in supply and demand, we can just watch a company for, let's say, a quarter or so.
So it's not that you're investing in any smaller or larger companies, but you now get more data points and confidence about their growth rate and trajectory.
And just the team.
Yeah, the team.
Yes, yes.
Yeah. Kathy, what are you seeing in, you're still making investments. It's still about the same level of the stage of the company, but how has your investing approach changed in the last 18 months?
Well, first of all, I wanted to say that, a lot of what we talked about today sounds a little gloomy, right? We're talking about the public markets resetting in valuation. We're talking about potentially, less companies that are performing well, and which might make it harder for companies that raise venture capital. But maybe this is my optimism, but my point of view is that the current situation in the macroeconomic market can also be viewed as a good thing, right? In 2021, we had an excess of capital in the ecosystem, right? Which creates certain behaviors that may or may not be good for a growing startup. What we're seeing now is that companies have to be much, much more deliberate on their business model, much more deliberate about how they grow, because they know investors like myself and Sapphire Ventures and Tehi and Storm Ventures are going to be looking at not just growth, but they're going to be looking at efficient growth. So I think the year of 2023 will really be a year of efficiency. And Greg, you asked me how it's affecting what we're seeing in the market. There's still deals out there to be done. But I will tell you guys that we are taking a much harder look at capital efficiency, which we generally measure using a net burn multiple. So how many total dollars spent to generate $1 of ARR? We track that metric very, very carefully. Best in class is really 1-to-1. Many companies, if it's anywhere from 1 to 2, that'd be great. But in 2021, you were seeing companies spend $5 to generate $1 of ARR, and that has gone away, right? Because that's indicative that the business model cannot support itself. The second thing that we're looking very carefully at is sales efficiency metrics. There are plenty of sales efficiency metrics out there, and if you guys Google, you'll find a number of metrics, but an easy one that I always look at is CAC payback, which very simply means the cost of customer acquisition. If it costs you $100 to acquire one customer, and that customer pays you $20 per month, you'll pay for that customer, you'll pay for the acquisition costs within 5 months, right? So it really depends on the type of business model that you have, the size of your customer, the size of your contracts. But best in class for the type of companies I'm looking at would be somewhere between 12 to 20 months, right? And the longer months would be for companies that have really strong retention, they're larger contracts, they stick around for a while, so you can afford to wait around a little bit for them to pay back. And so, echoing a little bit what Tehi said, we're asking for more data. We have a little bit more time to make the decisions, which might sound like a bad thing from a founder's perspective, but I always like to tell people that venture capital is a very long-term game, and the relationships that we build with our portfolio companies are very much long-term relationships. So I think spending extra time up front to really get to know each other, and that's unilateral, right? You should absolutely try to get to know your investor and their firm before you make a decision to take their money, can be a good thing.
And we're hearing the public markets, Mark Benioff talking about profits for the first time in 22 years. We'll see what happens there. But but in your stage of investing, it isn't profitable yet. It's not. But is there more
We
of a
have one
rule?
profitable. We have at least
One
a
profitable,
couple. At
okay,
least a
right.
couple.
Yeah, but are we back to a rule of 40 where the profit percentage and the growth rate adds up to 40 or something more reasonable? A reasonable growth rate and some capital efficiency, not losing too much money, or does that matter to you at your stage of investing?
I wish I had a clean answer for you, Greg.
Okay.
But it's a trade-off. It's absolutely a trade-off,
Yeah.
right? If you are building a category leader, well, you hope to be a category leader in a very exciting industry or on very exciting trends, like take AI right now, we're seeing AI, and it's a greenfield opportunity that's wide open.
Yeah.
Why operate the business
Right.
towards profitability when the market pull is there? For those companies, we're telling them, grow, 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 but grow smartly, right?
Mm-hmm.
For other companies that maybe are in more mature industries, maybe there's a lot of competition, there's a lot of macro headwinds, we might tell them, hey, let's slow down and evaluate the situation. A metaphor I like to share with some of my companies that I think can be attributed actually to David Sachs is if you are flying an airplane and there's a lot of headwinds, you could be burning a lot of fuel, but really going nowhere.
Right.
If there's strong tailwinds, you could be barely stepping on the gas or holding down the throttle and just be gliding. So you really have to evaluate what the market looks like for the company and determine how much, where you want to be on that trade-off scale.
Great. Miguel, what are the factors you're looking for, whether it's the three factors or three metrics that are most important when you're judging whether to finance a SaaS company? Is it growth rate? Is it confidence, annual contracts, so confidence in paying? Is it the steadiness of metrics? Or what kinds of things are you looking for that would be different than a venture capital investor?
Yeah. So, I mean, it's a totally different business model. So they will form a very long-term relationship with the founders. And we are only looking at the next 12 months, right? So we're looking at a combination of all the metrics mentioned here. So growth rates, rule of 40, gross margin, retention, and so on. And then our models, what they do is they project those to the future. They try different combinations, and they try to understand what are the recovery rates for those 12 months. So then if the recovery rates come positive, that's when there's a decision to how much money this company can access, for how long, and at what price. So it's very risk-based pricing. That we continuously adopt our credit policy to reflect, changes in the macro environment. And for example, now what we're seeing is that when we know the companies are doing the best, we usually index them by rule of 40, and then we also see which ones of them have more of an operational leverage. So that is primarily how big the gross margin is, and then what is the difference in the slope of their growth rate, of the top line growth versus their cost line growth. So companies that are increasing costs faster than revenues, those are on the wrong side of this metric, this operational leverage. The ones that are growing faster than the costs are growing, those are the ones that are probably going to escape this slump faster than anybody else.
So even though it's credit, you're still investing when there's momentum and accelerating metrics and good.
Another one also, companies need to have some runway, right? Think of our capital as a multiplicator of runway. So if you have 0 days of runway, anything multiplied by 0 is going to be 0, right? If you have 9, 12 months of runway, then that runway is going to become much, much, much longer with revenue-based financing. So that will also be a requirement, at least 3 months of runway. And the term of the revenue-based financing will adapt also based on the metrics. And if you want to optimize it, it actually is adapted to the CAC payback that Kathy was mentioning.
Yes, right.
If you know your formula, you know your CAC payback, the most efficient way to grow would be to get term loans that are exactly that CAC payback in term, so that for every cohort of customers you sign, you're always on the black.
Right. So we're finishing up here, and I think there'll be an opportunity to ask questions here. I'll just start with each of the panelists here. Tehi, what is the biggest misconception that founders, maybe some people you could talk to this week, have about when they're talking to a venture capitalist in the early stage, seed stage and Series A? What's a typical misconception they have about what you do and your type of funding?
Yeah, I would say the biggest misconception I see with founders when they're trying to raise money from VCs is to assume that all the people in the firm think the same way.
All the partners and investors. Yeah.
Like, for example, if you go to Storm Ventures, where I'm at, my co-founder, Ryan Floyd, we have been investing together for 23 years. And we all do early stage B2B software. And so you would think that have the same view in terms of metrics, in terms of priorities and so forth. And what you'll find is that we're all different. And so instead of thinking whether a firm is a good match for you, you should ask if that individual investor is philosophically a good match for you.
Great, thank you. Kathy, what's the biggest misconception did you have for, you're not talking to first-time SaaS founders getting their first institutional investment, but what misconceptions do founders have at the stage of investing where you're investing right now?
This might not be completely limited to my stage of investing, but
Yeah.
I saw this especially in 2021, where founders really over-indexed, in my opinion, on the quantum or the amount of capital that they raise per round. Of course, it's always nice to have a nice round number like 100 million for your press release, but the measure of how much money you're able to raise is not a measure of your company's success. That is a measure of how good of a fundraiser you are, absolutely, and that's an important part of the equation. But I always encourage founders to really take a step back. Of course, the amount of funding you raise and the valuation affects your own dilution, but really take a hard look at what sort of funding requirements your company really needs to hit those milestones, to really prove out your business model, to prove out your go-to-market strategy. And don't focus on the absolute nominal valuation or the quantum raised.
Sometimes raising more money isn't as beneficial as we
That's
see
true.
now 2 years later. Miguel, not everybody's familiar with revenue-based financing, a form of credit, not equity here. What is the biggest misconception that you and your team help educate SaaS founders when they're talking to you?
Yeah, so I would say besides the wait until the last minute to go and look for it, which you should never do for equity or for any type of capital, I would say it's two.
So if you're running out of money and you have no more runway, it's kind of too late, as you just described.
Yeah, but it's kind of too late for everything, right?
Right.
Like you should always be fundraising, whatever it is. I mean, out of a position of luxury, ideally, 6 months before you run out of cash, because these processes take time, right? I mean, we can do it in 24 hours, but if you want to raise equity, it takes time, and you never want to go to anybody at the last minute, because then they're either going to say, okay, I'll give you money, but it's going to be very expensive, i.e. your valuation is going to be extremely low, or it's going to be a structured round with a ton of teeth in the agreement, or if it's debt, nobody will give it to you because they will be taking equity-like risk for debt-like returns. So that aside, it's two. One is people trying to optimize for as much as possible, and the second one is the general misconceptions about comparing revenue-based financing with venture debt. So for the first one, getting as much as possible today, that is in revenue-based financing is not ideal because, or in debt in general, because if you're not going to use the capital quickly, you're going to be paying a ton of interest for capital that you're not using. So you're paying money, but that money is not generating returns. So we try to help our customers understand what is the right amount to take per month or even per week so that that money is put to work immediately, generating more returns than the cost of capital. For example, if you're going to invest $50K this month in customer acquisition, don't draw $1 million because you're going to be paying interest for $1 million versus just drawing $50K, investing into customer acquisition, and then next month maybe taking another 50 or 60K, right? The second one is revenue-based financing is not venture debt. Venture debt has had a bad rep sometimes because they get a perfect security over the company, and if they see the capital at risk, they will come in and they will take the company over. Right? In some cases, in some very notorious cases, companies are going to raise more equity. The new equity investors require the venture debt providers to convert part of the debt into equity, or maybe take a little loss, but make more of the principal back. And venture debt didn't do it, and the company died. And there are a bunch of cases about that. Revenue-based financing is not like that. There's usually not a security involved, and it is all based on revenue, right? So the risks of that happening are close to zero, where a capital provider would come in and take over the company. So that, again, is something that we spend time educating the market about.
Thank you very much. So we're running out of time here. I know our investors are going to be available to answer questions. So thank you, Miguel. Thank you, Kathy. Thank you, Tehi, and thank you to the audience for participating.
Thank you.
Appreciate it.
Thank you.